Welcome back to Stock Market Insights, where we turn complex strategies into clear, actionable lessons. Today, we're diving into one of the most reliable methods used by successful traders worldwide: trend trading. You've probably heard the phrase, "the trend is your friend," but what does it really mean? How do you recognize a trend? And more importantly, how do you trade it? Let's break it all down. Trend trading is a strategy that aims to capture gains by analyzing an asset's momentum in a particular direction. In simple terms, if the price is going up over time, that's an uptrend. If it's going down, it's a downtrend. Trend traders don't try to predict tops or bottoms. Instead, they focus on entering positions in the direction of the trend and holding until signs of a reversal appear. It's about riding the wave, not catching it at the very start. There are three main types of trends. First, we have the uptrend, which is characterized by higher highs and higher lows. This indicates bullish market sentiment. Next, there's the downtrend, where you see lower highs and lower lows. This reflects bearish momentum. And finally, we have the sideways or ranging market, where the price moves within a horizontal channel, showing no clear direction. Understanding these trends helps you avoid trading during uncertain or choppy conditions, which can lead to frustrating losses. Markets tend to move in sustained trends due to investor psychology, earnings momentum, and macroeconomic forces. When institutions start buying or selling a stock, they often do so over weeks or months, not in a single day. This creates longer-term momentum that trend traders can capitalize on. Rather than trying to outsmart the market, trend traders align themselves with the broader flow of money. This reduces emotional decision-making and increases the probability of success. Here are several tools and techniques commonly used to identify trends. First, moving averages, the most popular method. A rising 50-day or 200-day moving average often confirms an uptrend, while a falling one indicates a downtrend. Next, trend lanes. Drawing a diagonal line along the lows in an uptrend or highs in a downtrend can visually confirm direction. Then, price action. Simply look at higher highs and higher lows, or the reverse. Finally, technical indicators MACD, which stands for Moving Average Convergence Divergence, and ADX, or Average Directional Index. Each of these methods can help validate whether a trend is present and worth trading. Once you've identified a trend, how do you actually enter a trade? Common entry methods include breakouts, entering when price breaks above a resistance level in an uptrend or below a support level in a downtrend. Pullbacks, entering on a temporary dip in an uptrend or bounce in a downtrend, often near moving averages. And trendline bounces, where the price touches a trend line and continues in the original direction. Imagine Apple stock is in a strong uptrend, and price pulls back to the 50-day moving average. A bounce off this level with confirmation from volume and momentum indicators could offer a high probability long entry. Knowing when to get in is only half the battle. Exiting your trade properly can make the difference between a winning and losing strategy. Common exit strategies include trailing stop loss, which adjusts as the price moves in your favor and locks in profits. Fixed price targets, which are predetermined levels based on support and resistance or risk-reward ratios. Lastly, indicator-based exit, which involves the use of RSI, MACD crossovers, or moving average crossovers. Tip: always plan your exit before entering a trade. Emotional exits often lead to inconsistent results. Example: if you enter a stock at $100 and set a target at $110 and a stop loss at $95, you're working with a 2-to-1 risk-reward ratio. That structure allows you to win fewer trades and still come out profitable. Risk management is critical in any trading strategy, and trend trading is no exception. Key principles include position sizing. Never risk more than 1 to 2% of your total account on a single trade. Diversification. Don't overconcentrate on a single stock or sector. Use of stop-loss orders. Always set a stop loss to cap potential losses. Real-world scenario. A trader has a $10,000 account and decides to risk 1% per trade. That's a $100 risk. If the stop loss is $2 per share, the trader should buy no more than 50 shares. This kind of planning prevents emotional decision-making and catastrophic losses. Even trend traders fall into traps. Watch out for these. Entering too late. Don't jump in at the peak of an overextended trend. Ignoring reversals. Always watch for weakening momentum. Forcing trades in choppy markets. Sideways markets lack clear trends and often lead to losses. Pro tip: if the market is indecisive, stay out. Sometimes the best trade is no trade. Today's traders have access to numerous tools that make trend trading more efficient. Charting platforms, TradingView, Thinkorswim, Webull, Screeners, Finviz, Yahoo Finance, MarketSmith, Newsfeeds, Benzinga, Seeking Alpha. Apps for mobile alerts, set custom price or indicator alerts. Using these tools consistently gives you a real edge. Trend trading is not about guessing or gambling. It's about riding momentum in a structured, disciplined way. With proper tools, clear entries and exits, and solid risk management, you can build a strategy that stands the test of time. If you found this breakdown helpful, make sure to like, subscribe, and share so you never miss our next videos. This content is for informational and educational purposes only, and should not be considered financial advice. Always do your own research and consult with a licensed financial advisor before making any investment decisions.